So before you even think about placing that trade, you have to perform your pre and post market analysis, which you will learn what that is later on throughout the course. But even before that, you have to identify what environment the market is in. Is the market trending upward? Is the market trending downward? Is the market retracing? Is the market performing a reversal? Is the market currently in the middle of an impulse, or is the market ranging? These are things you have to be asking yourselves before you can even think about placing a trade. Just like when people go to war, for example, right? The foolish person will always just rush in blindly without a real specific plan, right? While the opponent is obviously planning out how they're going to attack the opposite side, right? So again, just like the wiser person that actually has a trading plan, you have to be able to identify what market condition price is currently in. So is price ranging? Is price trending? There's so many little things that you can use to help you identify these levels, such as Fibonacci retracements, trend lines, pivot points, support and resistance levels. All these tools are here to help us, right? Again, notice how I said tools. All of those are just tools for your toolbox, right? There's nothing that's magical about any of these tools. No one single tool will help you become a consistently profitable trader, right? So before even spotting or looking for a trading opportunity, you have to identify what type of environment the market is in. For example, right, let's say we were looking at this right here, right? Price right here is in the middle of an impulse to the upside. So it wouldn't be smart to actually look for a long position at that point in time. Where are we going to look for a long position? After a pullback. Or could there be a pullback? Well, we don't know when there's going to be a pullback. We just have to wait for price to actually start to pull back. And then we can identify that here, right? Price started pulling back here. Now, what can we help us identify what the market is doing next? Well, if we simply zoom out, we could see that over here we have a ranging market. It's not really going up or down. It's kind of just moving sideways, right? But we can take advantage of these opportunities, right? Now, if we look at it here, right, price is clearly going upward and it's moving in an upward trend, right? Now, if we look at price here, price is clearly pulling back. So again, you can use your tools such as the Fibonacci retracements, right? You could use the moving averages. You could use support and resistance lines, right? So here we have, let's just say, a level of previous resistance right here. We have another one right here, right? So again, all these tools are helpful so you can identify what price is doing. Once you've identified what type of environment the market is in, then you can move forward and look for an actual trading opportunity. This video, I'm going to be going over a bullish market structure pattern. So when price is actually trading bullish, meaning it is trending upward, meaning price is making higher highs and higher lows, typically we're going to be taking advantage of this by buying at the lows, right? And we're not going to be selling the highs. Why we don't sell the highs is because we're going against the trend and price can kind of reverse on us at any time. For example, if we believe that price is going to be going against us here, right, or if price is going to be going down here, right, to form a higher low point, we're not going to be selling this high because price at any time can continue to go bullish. Now, the thing about this is when price is actually trending bullish, you can very easily identify this structure because price is forming higher highs and higher lows. So this is a higher high, this is a higher low, higher high and higher low, right? So this is typically the actual structure for a bullish market condition. Now this is a higher high because this high is higher than our previous high, right? And this is a higher low because this low is higher than our previous low. Price will always be making higher highs and higher lows if we're in a bullish market condition. Now again, this is a higher high because this high is higher than our previous high. And this is a higher low because this low is higher than our previous low, right? Now you can identify when a bullish condition or when a bullish market structure ends and is no longer valid in multiple ways. Price will either come up, form a high, and then break this higher low, right? So we have a higher high, and then a higher low, and then a high. And if price breaks and goes under our previous higher low, this is called a break of structure, or a BOS, right? So when price actually breaks structure, we are no longer going to be looking to buy, depending on the time frame you're looking at, because price is no longer forming higher highs and higher lows, meaning that price could start reversing now. Now, depending on the time frame you're looking at, what price could do is come up, form a lower high, and then a lower low, right? So this would be our lower low. This would be our lower high. Now, again, this is very easily identifiable because this low, right, or this high is lower than our previous high. And this low here, which is a lower low, again, this low is lower than our previous low, right? So one more time, this high is lower than our previous high, and then this low is lower than our previous low, right? So now this bullish market condition is no longer valid, and price is going to start to most likely reverse, especially if you have what I call a 3-leg extension, right? So we have a 3-leg extension here. So when price has one burst to a specific side, then pulls back, then continues in that same direction, right? This is a 3-leg extension, and with this pattern you can identify a new trend. Same thing here. Price moves in one direction, pulls back, continues in that direction, a 3-leg extension, right? Price will then continue to go in that direction, and a new trend has started. Now that's how you can identify how a bullish market condition is now over. But now once it starts again, what price may do is do this as well, right? Price may form a low, break the previous lower high, then continue to go up, right? So this would be a lower high, this would be a lower low, this would be a higher high, this would be a higher low, then again a higher high. Why is this a higher high? This high is higher than the previous high. This low is higher than the previous low, making it a higher low, and we have a 3-leg extension. So now you can confirm that price is trending bullish again. All you have to wait for to buy is for price to pull back, look for confirmation that price is going to continue to go up, and then, of course, right here, this is when you want to buy, so higher low. And then your targets could be anywhere from the high to the highest high, to a higher high. Right, and again, price broke structure for this downtrend once price broke the previous lower high point, right? So that's the start of a new bullish trend here, right? So those are kind of the basics when it comes down to actual market structure for a bullish market condition. Now what I want you to do is pretty much kind of draw your own market structure, right? Practice your higher highs, your higher lows, and you can send it to me on Discord so I can verify if what you have done is correct. You can email it to me if you want as well. And again, do 10 examples of these. Get really good with understanding market structure itself, right? So in the next video, we're going to be covering a bearish market condition, and then we're going to be covering a consolidating or ranging market after that. In this video, I'm going to be going over structure for a bearish market condition. So typically when a price is trending bearish, you're going to see a series of lower highs and lower lows. So if this was an actual price action chart, let's pretend it is, right? This would be a lower low, assuming that price was previously trending downward before. This would be a lower high. This would be a lower low. This would be a lower high. So when price is in a bearish market condition, typically this is the type of structure that you will see. Lower lows and lower highs. So the most simplest form I could do it or I can explain to you when price is trending bearish. It's going to be moving from the left hand side of your screen to the bottom right. Along with that, again, it's going to be forming lower lows and lower highs. This is going to be considered a lower high because this high is lower than our previous high. And this is going to be considered a lower low because this low is lower than our previous low. So again, price is forming lower highs and lower lows. So it's really as simple as that. Now, when a bearish market structure is broken, price will either do one or two things. It'll form something like this, or I see one of three things, right? It'll do something like this, where price made a lower low, then a lower high, then a lower low, then a higher high, right? Again, this is a higher high because price got higher than our previous high. And again, each time frame has its own trend. So you have to be looking at the market structure for a more reliable time frame, such as the 4-hour or the daily time frame, when it comes to an actual trend reversing overall for the long term, right? So right here would be considered the break of structure. When price breaks structure, we will no longer be looking to short because price has broken our lower low and lower high structure, right? We're going to be looking to change our bias and go long, and looking for how we could take advantage of that opportunity to actually go long. So again, when price breaks structure, price breaks your previous lower high point. So this is one example of what price could do when it is going to change in trend, right? And again, just like in the last video we went over, you have a 3-leg extension. This confirms the bullish trend, right? Another example of what price could do when it is going to reverse is form a double bottom, which again you'll learn later on with the actual price action chart what a double bottom is, right? It's typically a trend reversal pattern. So again, price will form a lower high, then a lower low, or in this case, price will form a low, right, because they're equal, and then price will form a higher high, then a higher low, then a higher high. And then this 3-leg extension here confirms the bullish trend. And again, right, price broke structure after price broke above our previous lower high point, making it a break of structure, almost validating a change in trend here. It is confirmed, a change in trend is confirmed when price does a 3-leg extension where price makes the first higher high, then the first higher low, and at this point you're going to be looking to buy, right? And then price forms a higher high where typically you're going to be looking to close your positions. Now, last but not least, right, another version of a change in trend could look something like this, where price comes down, makes a higher low, then a higher high, then again you have your repetition of higher highs and higher lows in a bullish trend. So we have a lower high, we have a higher low, and we have a higher high. Once price breaks above this lower high point, it is considered a break of structure, and it is no longer in a valid downtrending structure. Again, it becomes a little bit more simple once you start applying this and learning this and looking at the actual chart and practicing your lower highs and lower lows, right? So those are kind of just some of the examples there of the higher highs and higher lows, right? So typically when we're going to be looking to actually trade a trending market, we're going to be looking to sell at each lower high, right? Lower high, we're going to be looking to sell at each lower high, right? We can use this with Confluence. I just wanted to go over the basic structure as of right now so you don't get too confused or anything. But we're going to be looking to sell at the lower high because think about it like this, right? If you sell at a lower low, you're selling at the most quote-unquote expensive price because price can pull back and discount. The bigger the discount is, the less risk you'll have because, again, for the trade to be valid, price cannot break above the previous lower high. So if you position your stop losses up here, right, you have a lot of less room for error compared to when you sell at a lower low, where your room for error is absolutely huge, right? And based off of risk to reward ratios, you'll be able to make back some of the profits you may have lost. So typically a pullback strategy is a strategy where your win rate does take a hit, and it is a little bit more of a harder strategy to trade, but the risk to reward pretty much makes up for all of that. So again, just simple lower highs and lower lows, just simple concepts. Trading is all about simple concepts put together in different situations, right? So in the next video, we're going to kind of dissect this a little bit more and what to kind of look for when it comes to actually selling at each lower high point. Alright, so in this video, I'm going to be going over what to kind of look for when going short on a pullback strategy. So there's many ways to trade a pullback strategy, but the very first thing you want to do is always look at or take more or less of a top-down analysis approach. So you're going to start off on the highest time frame and work your way down. But not to kind of overcomplicate things, let's just say this is this trend here, this bearish trend is the 4-hour time frame, right? Meaning each candlestick closes every 4 hours, right? So we've identified this is our previous lower high point and this is a lower low point, right? We're going to be pulling out our Fibonacci tool from point A, with being the highest point of our previous lower high, to our point B, right? The lowest point that price reached before it started to actually pull back, right? So once you've completed the course, you can kind of come back to this video if you're looking for a more simple answer. But what we're going to be looking for pretty much is for price to pull back to a PRZ level, right? In this scenario here, price has pulled back to about a 50% PRZ level, right? I know I don't have an actual Fibonacci tool placed. I'm just kind of making things up, right? So price pull back into a 50% PRZ level where we do see previous market structure. Again, if you look left, structure always leaves clues, right? So the likelihood of price rejecting this level here is very high, especially if you look left and you see price has rejected this level multiple times, either up or down, right? Basic support and resistance, which you'll get into that later on in the course as well, right? So the likelihood of price rejecting this level is fairly strong. Now, again, so we've identified that price could potentially be at a lower high point. A point A and point B on Fibs has been pulled, so now you have two confirmations. Price is at a 50% PRZ level. Confirmation number 3 is that price has pulled back to a previous level of structure, right? And now all we're simply going to be looking for is, let's say there's a bullish candlestick here, right? And let's say this specific bullish candlestick has a really big wick towards the top, right? Now what we're going to be looking for is either a bearish engulfing, right? I'm just going to draw a bearish engulfing there, where price closes under the previous low of that wick, right? So if we break this down to a lower time frame, price was doing something like this, right? Actually, I'm going to draw here. Price was probably doing something like this. It hit this level, right? Probably went above it a little bit, which would be this wick here. Then the next 4-hour candle opens, it came down, and the 4-hour closed down here, right? So this would be the current candlestick, right? Again, going back to our bullish market structure videos, a break of trend is when price breaks a previous higher low point, right? So price has broken a higher low point on our lower time frame, indicating that we may be possibly going bearish, right? We may start a bearish trend. You're going to wait for price to pull back, and then you're going to look for another bearish engulfing, and you're going to hit that sell. Or you can sell at this point here. It depends, you know, how kind of in detail you want to get to it. So you could pretty much just take a short off of the bearish engulfing candlestick on the 4-hour, or off of the bearish engulfing candlestick on the hour time frame, right? Because this is our lower time frame. and we'll get into time frame correlation later on in the video, but that's pretty much what you're going to be looking for when it comes to short. Now, you're going to get into candlesticks later on in the course, but the candlesticks that we're going to be looking for, the formations we're going to be looking for a reversal, right? Let's just kind of, I'm going to draw a couple examples here. I'm actually going to do this. Okay, so the first one, like I said before, being a bearish engulfing. The second one being a bearish variation pattern. The third one being a 3-bar reversal. And the fourth one being some form of an evening star, right? So typically an evening star is just a doji. Then an engulfing. Okay, so when it comes to a 3-bar reversal, you know, you'll learn about all these candlesticks later on throughout the course, right? But as of right now, you know, just for the simplicity of things and not to get confused as you're very early on in the course, this is pretty much what you're going to be looking for at a lower high point to take your short, so you have 4 confirmations to enter the trade. You always want to have a minimum of 3 confirmations that goes along with your bias to enter that trade, right? So, you know, again, you know, you can PM me anytime on Discord if you do have any questions. Depending on when you purchase the course, there may be new videos added to the course, so make sure you go back and watch those videos, and I'll talk to everybody within the next couple of videos. So as discussed in every other section, before you can even think about actually entering a trade, you need to identify what condition the market currently is in, what type of environment the market is currently trading at. So in this video, we're pretty much going to be going over examples of consolidating or ranging markets. Typically, you know, you have your main pattern here, which when price is in a range, you know, this could actually vary. You know, it really depends on the actual situation itself. We'll go over some examples and some reversals of an actual ranging market, and then we'll go on the chart. But pretty much when price is ranging, you'll have a high, a low, and that's all price is doing, is forming highs and lows, right? You'll have a level of resistance and you'll have a level of support that price is kind of just more or less failing to break. You can think about a ranging market or a consolidating market as price taking a break from really big moves. Now, you can definitely take advantage of this opportunity or many opportunities in a ranging market, but it all depends on how big the range is. Sometimes this range may be a 5-minute chart, and you know, this move from here to here was only 20 pips, which you could definitely take advantage of. Or, you know, this move from here to here may only be 5 pips. You know, it really depends on the range, or if you're trading a higher time frame, right? And let's say that this is a daily or 4-hour time frame, right? Then this move may be 100 pips, 60 pips, 70 pips, whatever the case may be, right? You need to identify the pattern. So typically, like I said previously, price is only going to be forming highs and lows throughout this range. Right now, there's many different ways you could tell if price is going to break out to the upside or the downside in a range. And that's, first of all, if you can identify if price had previously been trending before. So like in this example over here, right? Let's just say price was previously trending bullish and just started ranging. Right here you have a higher high, here you have a higher low. So then price formed a high, then a low, then a high, right? Typically in this situation, you really only want to be buying at the lows. You can even stack your orders if you want to, but I would definitely select my targets to be at the highs because you don't know if price is actually going to break out. But typically, you know, through previous back-tested history, we could see that if price is trending bullish and it starts to range, most likely it will break out to the upside. Right now, there's many different examples of this. Price may actually be trending bullish and started to consolidate, and then it broke out lower before breaking out higher. That's simply a liquidity grab. So pretty much stop hunts getting taken out of the trade, or sellers or buyers getting taken out of the trade early. So simple liquidity grab. Right now, you can also find reversals as well when price is actually starting to range. So let's say this is like a weekly key level here, right? If price hits this weekly key level, and on the 4-hour time frame, you see prices forming highs. So let's just say this was previous higher high, this was a previous higher low, then price formed a high, then a low, then a high. If this level breaks, then definitely I would be looking to go short. You can take advantage of this through many opportunities. If this is a weekly key level, you can just sell at the highs, or you can wait for the break of the range, the retest of the actual level of support that pretty much buyers were holding. Typically you want to see that sellers will hold this price for a continued push down. So that's the ideology behind a break and retest setup. So there's multiple ways you can actually trade this setup here. Now, last but not least is price when it ranges in a downtrending market. Typically when you'll see price form a lower low, then a lower high, then you'll see a low, then a high. Typically price should break down, break out to the downside actually, but you never know what price is really going to do. So again, you have to be able to manage your risk properly and make sure you're trading with a decent risk to reward ratio, especially when it comes to like pullback setups, right? So now that we've gone over pretty much some examples, I'm actually going to go into the actual chart and identify a ranging market. So now here we are on the chart, currently looking at gold. I'm going to turn off all of my indicators here just so we can look at price action itself, right? So the first thing you want to look at, and again, identify if price is moving sideways, right? This is a trending condition. This is a ranging condition. So the first thing you want to do, again, when it comes to ranges, they're more or less zones. So you want to draw out your highs, which would be somewhere around this level over here. And you want to draw out your lows, which would be somewhere more or less at this level down here. So as you can see, this range from the high to the low is about 70 pips. So you can definitely take advantage of these opportunities and go pretty much short on the highs and long on the lows themselves, right? Then you can see ultimately price broke above the range. As we discussed previously, price broke above the range, came back down, retested, buyers held the level of resistance that sellers were holding, right, and it's now come into a level of support and continued to go up. So again, there you have a break and retest of the actual range itself. This would pretty much allow for a great setup to actually go long here in this case. Now over here, this is another weekly key level down here on gold, which we're not going to go too far in depth on the level itself, as I'm just kind of explaining what a range is. But pretty much we have the actual low of the range being down here, and up here we have the high of the range. As you can see, price consolidated within the range itself here, right? So it's not always going to look kind of textbook perfect, but in this situation, again, you know, if price is trending downward, right, and this is a weekly key level like I've stated previously, right, so we can definitely expect a reversal, especially if price starts to consolidate like this. In this situation, what you want to do is pretty much buy at the lows, or like I said previously, you can also sell at the highs, right? But as you can see, you know, with that weekly key level, we had that rejection. But regardless of the fact, there's multiple ways you could trade this. You can have a limit order inside of the range, or you can wait for some form of a price action signal to actually take that long position. Again, your stops have to be somewhere decently under the range itself, because you will have liquidity grabs such as this one right here. And as you can see, price didn't really go for another liquidity grab after that itself. So really quick, this was just kind of a short example of ranges on a lower time frame. Now if we look at more or less a higher time frame perspective, right, such as the 4 hour, you can definitely see price was ranging here, price is ranging pretty much all throughout this level here. And again, another weekly key level, you can expect to short the actual highs themselves. But regardless of the fact, you know, you have a lot of ranges in the market, you have a lot of levels of consolidation. Typically price isn't always going to be trending all the time. Typically you're going to find price consolidating a lot more than often. So we can definitely look at this as another range here, right? Let's hit the replay tool, right? So you can see this as another level of consolidation. Again, here are the highs, here are the lows down here. So in this example, you know, the range was a good 150 pips. You could definitely take advantage of this range on a lower time frame. Again, sell the highs or buy the lows. It's really up to you. But anyways, this video was really just going over the market condition for a ranging market. And again, you have to identify what type of environment price is in before trading and setting up your trade.